Guys, John here. So it's about 11:30 at night in Florida, and I came across this article. And after reading it, I just want to hop on this live stream and walk you guys through exactly what's going on because I'm kind of losing sleep over it. This whole economy, this market right now is it's such a unique period for a variety of reasons. There's so much confidence that's getting pulled out of the market via stocks and crypto. A lot of money is getting parked on the sidelines and a lot of people are in the red. What I think is very likely to happen is I think that, and this is supported with what I'm about to show you, is I believe that we're going to see a lot of family offices and a lot of big pocketed investors pull their money out of traditional markets and look to allocate those funds with institutions, private equity firms, and banks to solidify and control hard real assets. I think they're going to want to be with people with a track record, someone managing a lot of assets, and someone that is, supporting a strong track record. And that's what it looks like we're stepping into right now. And I think when we couple the rising interest rates that we're going to see very soon with a unstable economy, I think what's ultimately going to happen is I think this is going to be like Christmas morning for private equity firms and for banks and institutions. So I'm going to read this article and then I'm going to talk to you guys about what I think is the best game plan for just everyday Americans and just everyday people that want to, solidify a strong position through the ups and the downs. So let me walk you guys through this. This came out today. Wall Street's $85 billion housing bet intensifies in the U.S. housing boom. I'm going to put the chat on. Let's see here. See what's up in the chat. What's up, everyone? I haven't done a live stream in a few weeks. So investors are snapping up lots to build an empire of suburban rental homes. Hey, what's up, Raymond? For the U.S., the housing shortage is a crisis. For Wall Street, it's a land rush. Institutional investors from JP Morgan Chase and Morgan Stanley to the Arizona state retirement system are pouring billions into their next big housing bet. What's fascinating here is when you think about it, where do most people go to get financing to purchase property? They'll go to the traditional commercial bank, right? Well, now imagine if the market pulls back like markets do from time to time, and they get more restrictive on their lending. They essentially can control the market just by controlling who can get loans, right? Not saying they're going to do that, but I'm saying what they could do is make it a little bit more restrictive, which would then give them even more power and control over the housing market. Arizona state retirement systems are pouring billions into their next big housing bet, building communities of single-family homes in the suburbs for renters getting priced out of home ownership. What I love about this article here is it's always how you tell the story. It's never really the story, right? They say they're building these communities for people that are getting priced out of home ownership. But down here, they say finding tenants is easy. The easy part is millennials with children, dogs, and the need for remote work space outgrows the confines of apartment living. But to succeed, landlords and their backers have to outcompete home builders for labor, materials, and most of all, land. That's contributing skyward costs that are rippling through the market, meaning prices for newly built homes may climb even further out of reach for would-be buyers. Single-family landlords, builders, apartment companies, and institutional backers have committed $85 billion for build-to-rent projects, enough to develop 315,000 houses, according to Alan Ratner, an analyst at housing research firm Zelman & Associates. Only about 20% of the money has been spent. They're sitting on, 65 billion in cash getting ready to deploy. It's already pushing up a lot of prices. Said 2/3 of the land sellers surveyed by the firm late last year said the for sale builders are now going toe to toe with rental investors. You got this new industry that's cropped up overnight, backed by Wall Street, Ratner said. Very quickly, the capital raise is competitive with home builder universe. The shift to new construction is the next step in Wall Street's bet that the American dream will tilt towards rentership. So this is what they're trying to push for. They're really trying to push to get everyone to become a renter. And this is why it is so important right now. I honestly, I don't think it's ever been more important to study your market wherever you are. Understand the market you're in. Understand how much money you're pulling in from your mainstream of revenue, whether it be your job or your side hustles. Figure out how much money you're bringing in versus how much you're going to waste in rent. Because ultimately what's going to happen is that rental that that waste is only going to be increasing when you have bigger and bigger players that are accumulating housing stock. They're going to continue increasing rental rates. Food prices are going to go up. Materials are going to go up. Things are going to go up with the supply chain problems. And wages are not going to be able to keep up. So if you can fix your housing cost, whether it be through a duplex or a triplex or a fourplex, whatever it is, fix your housing cost. That's going to be a great benefit in the long term, especially before all these players continue growing and getting bigger and bigger in this space. A decade ago, private equity firms helped stabilize. Look at how they picture this. A decade ago, private equity firms helped stabilize housing in the wake of the financial crisis by scooping up foreclosures at fire sale discounts and renting them to former homeowners with bad credit. An industry that rapidly grew and broadened the scope. They picture it as if they did a great thing for society. What ultimately happened is that these very banks that issued these loans, these predatory loans, they then basically absorbed their losses. They took the property over, re-rented the property, and grew in power and dominance over the years. This isn't a charity event, but this is what. But for now, home listings are disappearing fast. Prices are soaring, and many investors prefer building rental communities from scratch over an inefficient process of buying existing homes one by one. One bidding war to the next, grouping houses closer together also makes them easier to manage, eliminating the need to deploy workers to single-family homes scattered across a wide geography. Investors are buying everything from finished homes to entitled land and anything you can imagine to get scale, said Margaret Wellman, Chief Executive Officer of Wellman and Advisory Capital Markets, a boutique investment bank focused on home builders. The business is so appealing that traditional home builders are diving in themselves. Leonard Corp has teamed up with Centerbridge Partners and Alliance Real Estate to commit $4 billion to build and acquire purpose-built rentals. Pult Group, meanwhile, inked the deal to develop 7,500 homes for Invitation Homes, the biggest single-family landlord in America. That means resources are getting diverted from the production of for-sale houses while at the same time helping to alleviate the rental shortage. The effects are being seen in the Sunbelt areas where investors are most heavily concentrated. Chief Financial Officer, Reader Capitalist Partners, a Dallas-based family office with land development divisions that got a $100 million credit facility from Fortress Investment Group, recently made an offer for a parcel in North Carolina for a home builder customer, only to see a build-for-rent company come in with an unsolicited bid of about 15% or more. We have to go over this with our home builder with revised models and ask, at what price are you out? Hyde said. It's inflationary. It translates to an increase in the home price for the end user. Another thing that we have to also consider is that these private equity firms, even Invitation Homes, they're borrowing money at 1%. It's basically all free money. With inflation, they're getting this money for free. Whereas everyday middle Americans trying to buy properties with these rising rates, they can end up buying a house, a traditional 2-bedroom, 3-bedroom house, 1,200 square feet, at a 4% or 4.5% interest rate. Meanwhile, they're competing with someone else that's getting that interest rate for 1%, right? This is what's ultimately going to happen. This is why he's saying, at what price are you out? Invitation Homes can overpay, and they're still going to make money. Deals accelerate. The build-for-rent market is so small So far, with 14,000 houses under construction nationwide, according to data from listing service Rent Cafe, but it's growing fast. Nationally, about 6% of finished lots purchased in the fourth quarter were for rent house projects, up from 3% a year earlier. Data from John Burns Real Estate Consulting show in the Southeast, which includes hotspots in the Carolinas, Tennessees, and Georgias, the share was up 14%. The price of lots across the country jumped 17% in the fourth quarter, more than double the annual pace of growth 2 years earlier. Battle over land deals, rentals pushing up the price. Look at this chart. Just over last, really, this is when it all started. And you just see the compounding growth. It's unbelievable. Until the second half of last year, it wasn't penciling out for single-family rental companies to pay a premium for lots, said Greg Vogel, Chief Executive Officer of Land Advisor Organization in Scottsdale, Arizona, which brokered $4.4 billion in land transactions in 2021. Then rental demand went through the roof, fueled by the pandemic moves and soaring prices in the for-sale market. Rents in the U.S. single-family homes jumped by a record 12% in November, 3 times the annual growth pace a year earlier. According to data from CoreLogic, they surged 33% in Miami, almost 20% in Phoenix. Traditional home appreciation is about 3% a year. So you're talking about 10 years worth of home appreciation. 10 years worth of home appreciation in a single year. This is just the math, and the math is beginning to prove that they can pay more. You know, the game, this is why the game is it's tilted. And that's why, you know, I'm one that believes that the most important thing that anyone can do is have a moat of safety, a moat of security around yourself and your family. Whether it be if let's say, for example, you're making $50,000 or $60,000 a year, you're spending a decent amount in rent, have a nice car with a payment, you have expenses. The smart thing to do right now is rates are likely going to go up. And so the payments on the car, the payments on your credit card, all those things are going to be going up. Now's the time, I believe, to lock in, if you can get a good deal, a 30-year fixed rate mortgage, ideally on a multi-unit property, to cut back on that credit card payment or restructure the debt to get a fixed rate debt or get some type of payment plan to where you're not going to get hit on your credit card payments and get out of a car payment. Because what's ultimately going to happen is over the next year, 2 years, 3 years, when rates rise, opportunities are going to be presenting themselves. And unfortunately, it looks like these big corporations are going to be well positioned for those very opportunities, hence why they're sitting on roughly $1 trillion in dry powder as a whole. This article, they're talking about just $85 million for this specific model. Mark Wolf, a pioneer in the build for rent business who founded now San Antonio, Texas-based AHV Communities in 2013, said the big money newcomers are making aggressive bids. Their cottage-style projects in particular squeeze more homes onto the same acreage, allowing them to pay more for land. It's a mistake to discount the risk of future rent pullback. That's another huge problem that I think a lot of people are not paying attention to. When people are buying rentals right now, I'm saying this almost everywhere. People are buying rentals right now based on current cash flows, not taking into consideration that rents jump nationally, roughly 17%, between 13 and 17%. Some markets high as 30%, some down, as much as 7%, right? We've had all these gains based in the last, couple of years. If we end up losing 10% or 12% in those gains, and we step into a big problem, a lot of landlords are going to get wiped out because they're doing something, where they essentially take out a loan based on the new rental growth. So they have new rent growth in their properties. They're doing cash out refinances, taking the cash out, buying these other, rentals, and it's basically a gold rush. And people are really cashing in on these rentals. If there's a rent pullback, that could be a problem for a lot of heavily leveraged landlords. And then there's a really good point when they say that they make a mistake to discount the risk of this because it is a huge risk. Nothing goes up, 20, 25% in a year and doesn't go down. As the old saying goes, what goes up must come down. They're putting his home 30 or 40 minutes outside of town, he said. It's irrational exuberance to assume if you build it, they will rent it. George Cabana, CEO of rental company Transcendent Electra, said firms like his can approach land acquisition differently than for sale builders. It takes time to complete communities of homes, which the company plans to own and operate for years. So it's better to stockpile land before it gets even higher. Earlier this month, his firm reached a $1.25 billion deal to acquire lots in Florida, Georgia, and North Carolina. Unbelievable. It's a land constrained market. And we've seen values go up. We may even be able to pay more because we're long-term holders. Investors betting on rentals have another reason to be bullish. The Federal Reserve march to raise interest rates may squeeze already pinched homeowners and stall the for sale market. As mortgage rates rise over the next year, the monthly payment will go meaningfully higher, pricing more young families out of homeownership. Housing economists who advise large-scale developers on land purchases and the option of renting a brand new single-family home in a professionally managed, cohesive subdivision will be that much more attractive. Well, that's what's happening. That is what's happening right now. That's why I believe in summary, stock market is likely going to continue pulling back. Crypto market looks like it's pulling back. Fears coming into the market. Interest rates are going up, right? So family offices and deep pocket investors are likely going to start allocating more money to private equity firms and banks and institutions. And these companies are going to use that capital to acquire real hard assets, such as real estate, land, things that can't be duplicated again, right? And so you ask yourself, they're going to gain more power, and they're essentially going to control the level of how much leverage is in the market to utilize to acquire other properties through competitors, right? So what's ultimately going to happen? It's going to get, I think, harder to get loans if the market pulls back, and they're going to have a really good position to acquire a lot of deals. And if rents continue pulling up, if that does happen, you don't want to be on the rental side. You want to own something, a multi-unit property. Ideally, a triplex or a fourplex is a hell of a lot better than renting, because if you are renting, let's say, for example, you're paying $1,500 a month in rent, that's comparable to probably having a $250,000 mortgage or a $275,000 mortgage. So if you could pay $2,000 a month, but you can go up to, let's say, a $300,000 mortgage, and then you end up buying like a little triplex or a little fourplex, and you put 3.5% or 5% or 10% down, but there's value in that deal. There's equity in that deal to be made, whether it needs a little work, something you can do with your friends or your buddies, or maybe you have personal experience. You could fix it up a little bit. You could increase and enhance the value of that property. You can live one of those units. You could bring in some cash flow for the other units. If anything happens to your job, at least you have cash flow coming in. And odds are 3 tenants aren't going to stop paying you at one time. You might have one tenant not pay, but at least you'll have 1 or 2 that are paying, which will offset your mortgage. Just playing defensive mode, I think, is going to be really smart right now for a lot of people. Is playing defensive mode as much as possible, asking yourself, what do I have to do to bring my expenses to zero? And then when you're at zero, if you live in one of those units, you're bringing in cash flow, and you're eating healthy and taking care of your body and reading and doing well, you can get to a place of real growth and abundance. And if the market really does pull back, you'll be able to do some really big things. But the last thing you want to do is be stuck renting at one of these build for rent communities that private equity and Wall Street are building for everybody. But drop your comments here, hit the like button. I'm going to try to go live again next week. I have an office that I intend to move in on. It's on the 1st, but it's under construction, not far from where I am right now. And hopefully construction's done. If so, then the next stream, I think I'll give you guys a tour. All right, guys. Catch you guys later.